Okay, welcome everybody. Yep, the recording is in progress.
Mm.
Welcome to today's seminar. It's our monthly discussion and probe into life insurance and celebration of the magic of this product. Today's topic is an interesting one. It's about life insurance on children and talking about two of the reasons why people buy life insurance on children. One is to protect insurability of their children, and two is wealth accumulation. So, as a preface, we all recognize that this is a tough topic because life insurance gets paid when somebody dies. And if life insurance is on the life of a child, who wants to think about a child dying? I will say that that kind of reluctance to think about that it varies from culture to culture. I've had clients from the old country, as they say, who every time they had a new grandchild bought a burial policy on that child because their mentality was in the old country, infant mortality was a big deal. And they wanted to be able to give the tragic loss of a child an honorable burial. And so life insurance was bought for that exact purpose. Now, obviously, in today's modern age, infant mortality has become less of a problem, thankfully. But there are other reasons why people buy life insurance on children. The first one that we'll discuss is to preserve the insurability of a child. Now, Darren and I have worked on a number of cases for people who the industry calls higher risk. These are people who might have diabetes or breast cancer, a history of breast cancer, or any one of maybe 30 or 40 hereditary conditions. And as adults, these folks have a really tough time getting life insurance sometimes because the medical condition affects their mortality. And insurance companies understand this. And while they'd like to get the business, they do charge accordingly. So a lot of times the attitude of an adult who has a hereditary condition is, I really don't want my child to have to go through the trials and tribulations I'm going through right now to get life insurance when that child is an adult and marries and gets a mortgage, maybe starts a business, on and on and on. So they realize that a way to preserve the child's insurability is by taking a policy out on the child when the child is young. Could be a newborn, could be 1, 2, 3, or 4 years of age. This way, when the child gets older, if unfortunately they also get the family curse, so to speak, and they get diabetes or they have breast cancer, things like this, they are already insured. And in the long run, their parents have saved them a boatload of money by taking out that policy when the child is very young. And before we get into the ins and outs of that with Darren, I'll just identify one other reason why adults are buying life insurance on their children and grandchildren, and that's for cash accumulation. Meaning that if the grandparent or the parent would like the child to have a nice nest egg, a healthy accumulation of money that's liquid, that's has preferential tax treatment, can even be strongly guaranteed. They take out life insurance on the life of the child, a cash value policy, and given 20 or 30, even 40 years, a very attractive amount of cash can grow inside that policy. And so when the child gets married or buys a house or starts a business, there's a nice reserve of cash ready for them to get going. So those are two reasons we have found why parents and grandparents will buy life insurance on the life of a child. So Darren, having
Yes.
said that, let's suppose Mr. and Mrs. Jones have a 2-year-old and they're concerned about they'd like to buy life insurance for either one of these reasons on the life of their 2-year-old. Walk us through the process. What's it like? What does it take to get life insurance on a child that age?
Yeah, thanks, Steve. I think you set it up very well. So there's really two thought considerations. There's the insurance piece, and then utilizing life insurance in essence for, let's just call it a non-market correlated asset, right? So life insurance life insurance is always life insurance. We understand that. However, many people will buy life insurance, both on the life of a child or even on an adult, for financial planning purposes, meaning they can identify the benefits of how life insurance is treated from an accumulation standpoint. You mentioned, tax deferral. There's even opportunities to take money via policy loan tax-free. So then you're really talking about a Roth IRA alternative. So from a financial planning standpoint, it's kind of an exciting, unique way to use life insurance. And then, life insurance in and of itself, we always say it's magic. It's magic in the sense that it's unique in that there's no other type of financial vehicle that pays a death benefit. We don't know when someone's going to pass away, so that is a truly unique feature. Specifically for children, again, whether the parent or grandparent is interested from a death benefit perspective, you and I have had conversations frequently where, maybe we're working with a client in their 40s, 50s, or 60s, and, they see the cost of insurance, even if they don't have a medical impairment. You were highlighting, medical conditions. Forget about that. The cost, of insurance for a 55-year-old is, greatly more than, a 20-year-old, or even securing it on the life of a child. But to your point is, if the grandparent or parent says, hey, I think this is a good idea, either just to establish some basic insurance that I know, the child is going to need later in life. They're going to be married, they're going to have a family, so they're going to have a need. But let's lock in that price today that's going to be a fraction of what they would pay later. And the insurance companies understand this. I mean, they know that, yes, it's life insurance, but they know buying insurance on the life of a child isn't always just, the death benefit piece. They can kind of see the big picture. So it literally isn't radically different than applying on an adult. With that said, the underwriting, you and I always talk about pre-qualification, the underwriting piece. Fortunately for children, it's very accelerated. They aren't going to make children give blood or urine or, subject to any type of an examination. If they do have, any type of medical history, they'll simply get a summary from the client's pediatrician. The only, I would say, financial underwriting piece is if a parent is buying insurance on a child, the carrier will say, hey, we want to be sure that you also have at least a basic insurance, program on yourself. Obviously, we want you to have the protection to benefit your family versus just buying on the child itself.
Oh, so that point is, so the insurance carrier will not issue a policy on a child if the parent is not sufficiently insured on their own life.
In general. Now, there are exceptions where maybe the parent is precluded or uninsurable, or there's a reason. But what my point is it is something that we'll have to address initially. If we were to get a call from a parent, hey, I watched your seminar. I think this is a good idea. Fine. But what do you have first? And if it's reasonable, insurance companies are all about reasonable. If something makes sense, they're fine. If neither the mother or the father had any coverage whatsoever, and they were trying to purchase $1 million policy on a 2-year-old, they might say, well, I hear what you're trying to do, but let's let's think through this a little bit further. So just something, that we would talk about up front with the parent. And then the grandparent scenario is not as much, because it's more of a gift. But it's, again, we just have to provide a summary to the underwriter to explain what the purpose of the insurance is.
Right. All right. So let's walk through the mechanics of the policy. So we have little Joey is the insured. He's 2 years old. So one of the parents then becomes the owner.
Yeah, typically, I mean, obviously a minor can't own a policy. So typically, we would have a parent own it, and then they would retain ownership. Honestly, as long as they felt it was appropriate, and then maybe when they see little Johnny has matured and is off doing his thing in life, who knows, 20, 25, 35, whatever it is, then maybe they transfer ownership at that point to the child who's now an adult.
Okay. And um, the fact of the matter then is that if the child has, let's say, reached age 25, but the ownership, but is not yet the owner of the policy, the child can't access the cash. It's the owner that's going to control access to the cash, correct?
Yeah, that's a good point. Yeah, the owner of any policy, and we talk about this a lot, the owner controls the policy. So whether it's an adult or a child, it's not the insured, rather it's the owner.
Okay. And who would be who would be the beneficiary typically?
I mean, commonly the parents, why the child is a minor, and probably, beyond that until they get married, they would retain a beneficiary designation.
Okay, and obviously the parents would be the premium payer. You mentioned that it's kind of very streamlined underwriting, that there's no exam. There might be a review of medical records if the child unfortunately has a medical condition. But we also know that a lot of times parents who have a family medical history are interested in doing this. Like I had a client once, she had a history of breast cancer. Her mother had a history of breast cancer. Her mother had a history of breast cancer, and she had a daughter. And she's like, I need to get life insurance on my child. And because unfortunately, there's a good chance my daughter's going to have breast cancer and make it real hard to get life insurance. Okay. So I can't quite remember how it worked, but will the underwriter put extra weight on family medical history if there's a history like that in the family?
I mean, as we know, we're learning more and more about genetics. The underwriting community or the actuarial community is not any different. They're getting more data as far as, certain type of, genetic markers and what have you. So they certainly can use that as an underwriting factor. With that said, I mean, they're not gonna not offer coverage for a child just because they may or may not have a genetic marker, which may or may not result, in some condition. And then another point to consider is most companies only have a certain classification for children, meaning, so if you or I apply for life insurance, there's all these different classifications. There's preferred, there's a standard plus, there's a standard, just based on different criteria. For kids, generally most companies just have a standard child category, meaning if the child's healthy, they're going to get that classification. So in essence, there's one premium for a 9-year-old male and one premium for a 9-year-old female with that specific company. Rarely do you see them, do different criteria. I guess mainly because they haven't gotten to an age where they can actually underwrite, their specifics as far as blood pressures and cholesterols and heights and weights. I mean, if you see something grossly out of line, I mean, on occasion you see, maybe a child that's extremely obese. We talked about medical conditions. They can rate a child at an extra premium if they see something. But to your point about genetics, they may look at it, they may investigate it, they may request a medical report, but we probably aren't going to see it radically change their eligibility.
Okay.
Yeah.
And that varies from company to company, I'm sure, so
Yeah.
that if one company weighted it a little bit more heavily, and that influenced their premium, then we can go to another company that gives less weight to it. So,
Yeah,
because they do differ in their standards.
Yeah, no difference than how we work as brokers. I mean, for any given client, we may start with John Hancock, and John Hancock, doesn't look at something as favorably as maybe AIG or Protective or Transamerica. So again, we're looking out for the client, and whoever makes the best offer, then that's who we place it with.
Good. All right, let's pivot now to the use of life insurance for cash accumulation. Again, we have Grandpa Jack, who's heavily insured himself and knows the benefit of growing cash inside life insurance and wants to therefore take out a policy on his grandson, so the grandson can also reap the benefits. Are there certain cash value products that are better to use in that strategy than other ones?
A lot of times, to your point, a grandparent may already have an experience or may already have, a like for a certain type of product. So, for instance, they may have had a whole life policy, when they were younger, or maybe their parent or grandparent bought something similar. But yeah, either whole life or cash accumulation, universal life. Very, very similar, some nuances, but both accumulate cash and can serve the same purpose. So it's just a matter of maybe more of an education piece up front, maybe talking to the client about both types of policies and being sure that they understand the nuances. Usually when I see grandparents, it's, hey, Darren, I believe in life insurance. I think it's important. I would love to gift this to my grandchild and establish this policy to show him the importance of which he won't understand for many, many years. But someday he's going to be like, wow, Grandpa Jack bought me this, and now it has $25,000, and maybe I need it for school. I actually did that for my own son. My own son is 20 years old. I got him a whole life policy when he was born with Mass Mutual, and there's a nice chunk of money. If we don't use it for school, then that's something that he can use later in life. Or fast forward, we had a client recently that had a whole life policy for years and years and years, and I think it ended up accumulating $150,000, and now he's approaching retirement, and we showed him a way to take that 150, use an IRS code 1035 exchange, move it into a fixed investment that's going to give him a lifetime pension. He's like, wow, so all this money that was sitting there, I knew it was great, but I never knew how I was going to use it. So now we're turning it into a lifetime pension that he can't outlive. So many neat things you can do with it, but it's like anything else. You got to get started, and you got to contribute every year, and the miracles of compounding interest and dividend payments.
Yeah. And you did mention earlier that the life insurance product provides cash on a basis that's not tied to the market. So it's
Yeah.
not an equity. We're not worried about the ups and downs of the equity market. So that's telling us that it comprises the more conservative part of somebody's portfolio.
Yeah, definitely one of the more conservative strategies that somebody could incorporate.
Right. So if somebody is a believer in having a diversified portfolio of assets, then some of that will be aggressive, some of that will be moderate, some of that will be conservative. And on the conservative end of the spectrum, life insurance with its guarantees, for instance, is a good bet to have.
Yeah.
Good.
What I started to say earlier, and I didn't finish my thought. So particularly working with grandparents, and got a lady in Nebraska, in God's country. I think she's up to 7 or 8 grandchildren, and every time a new grandbaby comes, I get a phone call, and hers was a premium commitment. So it's, hey Darren, good news, we have a new granddaughter. I'm like, great. Are we doing the same thing? She's like, yep. And she contributes $50 a month for each grandkid.
Right.
Now, granted, it's going to buy a slightly different amount of insurance based on, did she do it when the kid was brand new born, or did she wait till it was 1 year old? I think some when we started were already like 2, 3, 4, so they each have slightly different amounts of insurance, but it's just a premium commitment.
Right.
And it's ever that way in her mind. Everybody's getting the same gift.
Right. Right.
And years and years down the road, each grandkid is going to have something from grandma, and that's going to be her legacy. It's a legacy deal where she wants them to know that she loved them, and it was her way of saying, hey, I think it's a good idea to have life insurance. And oh, by the way, here's this sum of money that I want you to use responsibly, hopefully.
Right.
And think about me.
Right. That's marvelous.
Mm-hmm.
Is there anything else that we should say to wrap up our discussion today?
I think that's it. It's to go back to where you started. It's to kind of get away from the morbid, thoughts of, oh, life insurance on a child. I don't want to think about it. Which some adults don't want to think about it because they think it's morbid to do life insurance planning. But it's again, I'm a financial advisor, as you know, so it's a piece of the financial plan. Aside from cash value, having that unique financial vehicle that provides a death benefit is, and oftentimes really, really important when something happens, particularly prematurely, but even later in life, to have that guaranteed sum of money to flow into an estate, so people don't have to juggle, so they can be okay. They don't have to sell this or sell that, or
Absolutely. Once you expedite even one benefit, one life insurance claim, and you see the reaction of the beneficiary in their time of grief and woe to have that money, you can see that it is a magical product.
yeah.
Thank you so much for this great discussion. Thanks everybody for joining us. Have a very happy Thanksgiving, and we will see you all in December.
All right, guys.
Bye-bye.